This is the Wealth Exec. Let's reach your goals together. My name is Carrie Amaro, and I started the Wealth Exec to help as many individuals as possible, whether you're a business owner, an executive, or anyone interested in learning. I hope you're enjoying the 12 Business Days Till a New Year series. We are on day 10. Cash is king. Now, what's the difference between the statement of cash flows and projected cash flow reporting? Before we get started, the reason why this was held to one of the last episodes is because you need to make sure you have a handle on your balance sheet and income statement, whatever projections and forecasts you are thinking of making going into the new year. My belief is that a business owner, or anyone for that matter, should not have to be an accounting expert to understand financial statements, but you should, however, be able to review them and make well-informed business decisions. We all know cash is king. Remember, it's basic economics. If you can't pay your bills, it's virtually impossible to stay open. Now, there are two great resources that one has at their disposal, and that is the statement of cash flows and your projected cash reporting. The trick is to know what the difference is. I know I make it so mysterious, but it really isn't. The statement of cash flows is not only one of the financial statements required by GAAP, but I believe it to be one of the most intuitive. It allows you the ability to look back at trends to see how the organization has performed under various strains throughout history. Why? Because it records cash activity for a specified period of time, breaking it down into categories such as operations, investments, and finance. Now, if you recall, I think it's in our second lesson, we discussed the fact that the statement of cash flows ending balance flows into the balance sheet cash account. A further indication on how important it is to understand all of the financial statements as a whole. As I'm recording this, I want to make sure that I don't get too into the weeds. So why it is important. In the workbook that's attached with this PDF, you will have the opportunity to jot down ideas as you're listening to the podcast or as you're reading the materials. The things to note with the statement of cash flows is the fact that it allows you the ability to look back at trends, to see an organization's performance through various strains throughout history. For instance, if you have a cyclical business dependent on season, it can guide you on how much money is needed at a certain period in time or what strategies you need to undertake to ensure you have enough cash to get you through those trying times. If you have to think of taking a loan out, or if you have to think of adjusting terms that you're giving to your customers, or possibly discussing with your vendors extending payment terms. Now, when you look at the statement of cash flow as a segue into understanding your business, this is a good time to identify extraordinary items, because I don't want you to try to take the history of your organization and not take into effect something that happened in one instance that is not going to be a repeatable item. Such as a time where you had to pay your vendors a lot more than you're paying them now because you were new to the industry or because you had a falling out. Or a time where you had an uptick in sales because of an extraordinary item that you were not able to repeat the next year. Now, I want to point out that because you have positive cash flow, this isn't always good. Positive cash flow could be because in a particular period, you actually had to take out a loan, and that cash is due to borrowings and a liability that you just created. So in the PDF, I've included a few lines for you to jot down any occurrences or any time periods in which this happened. Also, a negative cash flow isn't always bad. It could be something that was an expected period where you knew that you were going to be tight with monies. It could be a period of growth, and you may want to note that and possibly jot down some lessons learned. Isn't this so exciting? So now moving on to projected cash flows. The difference between projected cash flows and the statement of cash flows is the fact that projected cash flow reporting is the process of predicting cash levels in the future. It's the process of anticipating receivable receipts and payments. This is very key to get this as accurate as possible which hence again, I'm going to sound like a broken record, entails you understanding your balance sheet and your income statement. Why? Because that houses your customer relationships, that houses your sales, it houses your vendor relationships and who you owe money to, and how much you can use that relationship, whether it be with your vendor or whether it be with your customer, to mitigate instances where you're short on cash. For ease of time, I don't want to get into the nitty-gritty of creating a projected cash flow in this particular podcast. I will, however, be opening up a private group to discuss all of these issues that we have addressed in these 12 weeks. Now back to the projected cash flows. Even though we're not getting into the how-to part of creating it, one thing that I want to point out is make sure you understand your beginning balance and what it entails. If you are a small company and starting out with looking at your checking account and saying that's my beginning balance, or if you are working with a reconciled bank reconciliation in your accounting software, just make note that you're including outstanding checks. Next, you want to determine your accounts receivable expectations and get a handle on fixed and variable expenses, such as things like rent and cost of goods sold. The benefits of forecasting is the ability to predetermine cash surpluses or shortages. It takes into consideration your sales projections as well as your customer and vendor relationships, which is why we first start out with what we know, which is cash on hand, and then we can predict our accounts receivable trends, our payment terms with our vendors, our sales projections, and these projections come from what? The forecasting process that we discussed earlier in the 12 weeks. There is a quote by Luis Pasteur which says, "Chance favors a prepared mind." I know we can't predict everything, but trying to be prepared is better than not. The potential to identify and mitigate hurdles is so key. Proactively working on ensuring your payroll and fixed expenses are covered will give you a better opportunity in the time of downturns in the market to stay afloat. It gives you a wonderful platform to discuss loan possibilities with your bank or investment discussions. It also allows you the opportunity to have discussions with your vendors. It's better to eliminate the surprise that you're not going to be able to pay them on time in a specific period. You can also evaluate if in hard times you want to offer a promotion or early payment discounts to your customers. In short, both the statement of cash flows and cash flow projections are so very important in the success of an organization. Ensuring that balance sheets and income statements are properly recorded foster the ability to mitigate surprises. I hope that you've been enjoying the series. I'd love to hear from you. Please leave me a review or visit our social media platforms on Facebook, Instagram, Twitter, and like our pages. Or you can simply visit thewealthexec.com. Till next time, let's reach your goals together. Take care.